Hi, welcome to Focus on Finance. I'm your host, Melanie Parker. Today we're going to be talking about the 2017 Tax Cuts and Jobs Act, a quick review. I'm reading that because that is a mouthful. And with us today we have Steve Wright, managing member of the Wright Legacy Group. He wrote a column about just this in the News Enterprise earlier this month in January, and he is going to expand on that for us.
We was able to do a quick review in the News Enterprise of just some bullet points. We're going to go over those bullet points today, but go to a little more detail on what that means for you as a taxpayer and the benefits and some drawbacks that you need to be aware of. The first thing that this Tax Act did is that it increased the standard deduction. The standard deduction when you're filling out your tax return is the amount of money that you can earn before you start paying taxes. And up until this act was passed, the standard deduction for married couples was $12,700 for 2017. Well, for this year, 2018, that nearly doubled to $24,000.
As combined income?
Yeah, there was. Yeah, for your filing jointly, first $24,000 is not counted as taxable income.
Wow.
So you can make more money before you even start paying taxes. And for single individuals, before it was $6,350, and now that has almost doubled to $12,000.
That's substantial.
Yes, a substantial amount of money that you can make before they even start getting you to the tax table, more or less.
Wow.
So a doubling of the standard deduction is a huge benefit. And then for people who are over age 65, blind, disabled, to get an additional exemption on top of that. So what it basically means is that with the standard deduction, you generally can make a little more money before you start having to pay tax on that money there.
Yeah, that's
a good deal there. Yeah. The other thing that happened with this tax cut here is we have seven tax brackets. There were a lot of discussion to take it to 5, but when the final version came out, we still have 7 brackets. But the good news is that those brackets, the tax for those brackets went down, generally about 3%. So what I mean is for 2017, again, a married couple filing jointly can make up to about $75,900 and be in the 15% tax bracket. Well, with this new tax bracket for 2018, that same couple married filing jointly can make $77,400, about a little bit more money, and they'll be in the 12% tax bracket.
Okay.
So basically, you can make a little more and pay about, that bracket has dropped 3% from 15 to 12. And that is a very general description of what it means for you, particularly as you file your taxes a year from now for 2018, is that you can make a little bit more, be in a lower, generally about 3% lower tax bracket. So that's good news.
Sure.
Now, where this will affect you before filing taxes next year is that the IRS is telling by mid-February, early March, they will have these new tax tables out to payroll companies, to your employer. So when you start getting your paycheck late February, early March, you should see more dollars net take-home pay because your tax bracket has gone down. Now, they're going to rely upon the W-4s that you have on file with your employer, and if you need to change your deductions or change your withholdings and things, you need to file a new one. They're going to use the old one to calculate this new bracket.
Is there a cutoff to update your W-4?
No, you
can do it anytime?
You can do it any time with your employer, throughout the year, yes. But the point being is, somewhere here soon, you're going to have more money net in your paycheck. And if you want to adjust that, then you need to file a new W-4. So let's keep that in mind. So the positive effect of meaning more money in your pocket will be felt here in just a few weeks or so. But the long-term effect will be when you're doing your taxes next year.
Right.
You'll have a better idea where you stand. But in general, make a little more, and even if you stay in your same tax bracket, you're going to owe 3% less than you did in 2017.
We'll take it.
No, everybody will take it. That there. And talking about filing taxes, this is kind of interesting. I have a 2016 tax return here, and I have a 2017 tax return, which people are working on now. And the difference is only one thing. The 6 was replaced with a 7.
Well,
these tax returns are just about identical. Okay. Now, I won't even bring that up because next year, 2018, because of the higher standard deduction and the lowering of tax brackets, 2018's tax return will look drastically different from this one. So the point being, if you did your own taxes, use tax software for 2017 and 2016 stuff, you may be okay this year, but throughout this year, next year, may be the time to hire a professional in order to help you prepare, because it's going to be totally different tax return from that. So these are available now, but there's really no different from the ones we did a year ago for 2016 on there. So
That's good to
keep
know.
the tax brackets in mind there. The other thing that had a lot of discussion was being able to deduct your state and local property taxes. If you own property here in Kentucky, you know that you get a friendly note from the city, a friendly note from the county saying, hey, because you own property, you owe tax on that.
Right.
When those taxes are what help fund city governments, county governments, and things like that. Well, it used to be an unlimited deduction. So if you own multiple buildings around town, multiple rental property stuff, you pay property tax and you could deduct all of that. Well, this Jobs and Tax Cut Act eliminated all of the deduction, meaning it put a cap on it. You can only deduct state and local property taxes up to $10,000. So if you have state property taxes that are $15,000 in 2018, you'll only be deduct $10,000 of it. So it put a cap on how much you can.
That could really affect some people.
That could really affect people that own a lot of real estate,
Right.
some major business owners and things of that nature. But for the average person in Kentucky that owns a home, maybe a little land and things like that, that won't affect. They'll be able to deduct almost all that they pay in for state and local property taxes and all. So it will affect some, but not all from there on that. The other thing that is kind of interesting is the government for years has allowed you to do a child tax credit. All right, if you have children, that your children or you adopt and things of that nature, and if you're raising them, you get actual tax credit. That can go up to $2,000 now per child.
Wow.
All right. Now the thing you have to understand, a tax credit is so much better than a deduction.
What is the difference between a credit and a deduction?
Great question. If let's say that you have a $50,000 income and you have a deduction, say you put $5,500 into your IRA account for retirement.
Okay.
Well, the deduction means that you reduce your income from $50,000 minus $5,500 to $44,500. It reduces your income before taxes is applied.
Okay.
It's a deduction. A credit is totally different. When you get on the back of your tax return here, and for 2017, you get to line 43, taxable income. Okay. This is after your deductions, how much your taxable income is. You go to a tax table, and let's say it says you owe $4,000 in taxes. Well, you come down here to line 49, credit for child care, like this $2,000 deduction.
Right.
Since it's a credit, since it's a credit, you get to subtract $2,000 from the $4,000.
Okay.
It's a dollar per dollar offset of taxes that you owe. So if you owed $4,000, you got $2,000 child tax credit. Your 4 minus 2 means you only owe tax on $2,000.
Awesome. So a deduction is more on the front end and a credit's more on the back end?
That'd be a good way to put it. Yeah.
Okay.
But with a deduction, the advantage of the deduction is only based on the tax bracket you're in.
Gotcha.
If you're in a 15% tax bracket, then the deduction is reducing. It has like a 15% benefit.
Okay.
A child tax credit or a tax credit, period, of any type, is a dollar for dollar. It reduces your actual tax owed dollar for dollar.
Right. Unfortunately, all of our child tax credits grew up, didn't they?
Well, you can always adopt, I guess.
Right. No,
from
I'm
there.
good.
On that. Anyway, and I'm gonna jump down here a little bit on our list.
Sure.
Part of what was done in this Tax Cut and Jobs Act, think about that, is that they did do one thing to the Affordable Care Act, the health care plan that was voted on back in April 2010, is that in this Affordable Care Act, it mandated that you had to have insurance, health insurance. And if you didn't have health insurance, when you did your taxes each year, you had to pay a penalty, a dollar amount or a percent of your income, with the goal in mind of encouraging younger people who felt like they didn't need insurance to have to go in, pay insurance, because of all insurance it's a pool of people putting money in together to cover claims by everybody else. And most of the time, most of the claims are paid out for older individuals, and younger individuals put money in and never get anything out because they don't get sick or things of that nature. But it's insurance in case they have accidents, stuff like that. Well, that didn't prove to work as planned, and so in this remember Tax Cut and Job Act, they eliminated what's called the individual mandate in the Affordable Care Act, meaning that starting in 2019, you will no longer be penalized if you do not have health insurance.
Right.
Now, you're on your own. That's a risk you have to take.
Right. They tried it, didn't work.
But I mean, if you don't have health insurance, you will not be penalized.
Right.
So they kind of took a swipe at some healthcare issues along the way of passing this here. So anyway.
So when they file their taxes this year, that still applies though?
Yes, for 2017 and 2018 from what I have read.
Gotcha.
Okay? This is kind of interesting. This has been law for not quite a month, and I'm still picking up more details down through the line there.
Sure.
So a disclaimer. Something I say today may be to be tweaked in a little more fashion in a few weeks.
As of today, this is what it is.
So what you got to have a good tax advisor to help you with that stuff there.
Sure.
Okay. And then on medical expenses, what was interesting, this was passed predominantly for things beginning January 1st, 2018. However, concerning medical expenses, this was part of the law that went back retroactive. Okay, so here's what I mean. Many individuals, if you have high out-of-pocket medical expenses, for 2017, before you could deduct those medical expenses off of your income taxes, it had to meet a 10% threshold, meaning that it had to meet 10% of your income before you could make those deductions.
Is that gross or net?
You got me there. It's actually on your taxable income.
Gotcha.
There.
Okay.
And so, but for 2017, there was a 10% threshold. Before that, it was 7.5%.
Okay.
Well, part of this act went retroactively and said during 2017, you're filling out your taxes now. If the threshold for deducting your medical expenses is going to go back to 7.5%.
Okay.
For 2017, 7.5% for 2018, and then in 2019, it's supposed to go back up to 10% threshold. Okay?
Gotcha.
So that's important for people that have a lot of out-of-pocket medical. They can only deduct that if it meets a certain threshold.
Sure.
So that's a good thing.
Would that be co-pays?
Well, it could be co-pays, it could be prescription, things you pay out of your pocket.
Gotcha.
Paying for in-home care for a spouse or things of that nature.
Right.
Yeah, there's
That
a lot
could add up
of
pretty
things
quickly.
there. There's the qualifying expenses, and the
Sure.
IRS tax form has a list that qualify,
I bet.
a list that don't, so you have to kind of check into
Sure.
that.
Definitely worth looking into if you feel like you
Very
even
much.
have a possibility of meeting that.
Very much going into that
Great.
there. There's a lot of discussion now about whether I can still deduct my mortgage interest on my home. Okay, I have bought a home, I have a mortgage, I'm paying interest. Can I still deduct that? The answer to that is generally yes, and for most of our viewers, it will be yes. The tax law, before they did this one, you could only deduct interest on the first $1 million of your mortgage. And the tax law reduced that to $750,000.
Okay.
Now, the caveat there is this only applied to new mortgages that were taken out in November of last year going forward.
Okay.
All right, so if you took out $1 million mortgage December of last year on a home, you're only going to be able to deduct interest on the first $750,000. For all existing mortgages and things, it was all grandfathered, as they call it.
Okay.
So only going forward will that apply. But one thing that is snuck in there that is kind of disappointing is that we encourage a lot of our clients to have home equity lines of credit. They own their home, they got a lot of equity in it. Just have a line of credit at the bank for $10,000, $15,000, $20,000, $30,000, just as a quick emergency fund.
Sure, a little buffer.
Heating unit goes out, you need a new roof, you wreck your car, you need a new one, just where you can just go get the money without having to officially apply for a loan. You're pre-approved for a line of credit at your bank. And one reason is because the interest on the home equity line of credit has been deductible from your taxes. Well, this new law generally eliminates that tax deduction for that.
Really?
Which is kind of disappointing because it's a real flexible tool for things of that nature there on that. There was a lot of questions we've had from individuals over the past couple weeks. Will I still have to pay tax on my Social Security? And did that change? And if you receive a Social Security check on line 20A, you have to put in how much your gross benefit was, and then you will either pay zero tax on your Social Security income, 50% or 85%. And the brackets for that did not change.
Okay.
Meaning they did not get adjusted for inflation or anything, but it's the same as it was last year and the past couple of years. If you're married filing jointly and your provisional income as defined by the IRS is under $32,000, then none of your Social Security is taxable, none of your Social Security benefit checks. But if it's between $32,000 and $44,000, then you have to pay tax, count as income, half of your Social Security benefit check.
Okay.
And if it's over $44,000, 85%.
Wow.
Now, if you're single, it's under 25%, 0, 25 to 34,000, 50%, and over 34,000, 85%.
And that's something a lot of folks don't realize. The baby boomers coming up that are retiring, that their Social Security is potentially taxable.
Potentially taxable, and they don't realize it till the first year they draw Social Security benefit checks,
Right.
and it's right here on line 20 of the tax form. It's been there for many, many years,
Right.
but they never
You don't-
received a benefit.
Right, you don't pay attention if it doesn't apply
Right.
to you, right?
But the point is these income levels, 32, 32, 44, those numbers did not change.
Yeah.
There was a lot of talk of saying you had to have income of over 50,000 before it was taxed, but it did not get in there. So the Social Security table for calculating benefits on tax on Social Security did not change at all.
Good.
So that came
Okay.
out there. There was some other odd and end things here that was kind of interesting. There's on the subject of Social Security, right now, whether individuals get a raise in their Social Security check, it's based upon the CPI-W, which is like urban wage earners. They're looking at doing what's called a change CPI. They're proposing a CPI, Consumer Price Index, based on elderly, because the spending habits of someone that is retired is different than someone in their 20s, 30s, and things like that.
Their priorities are
So
definitely different.
there's a big push to eventually get to a Consumer Price Index that is based upon the spending habits of individuals who are actually receiving Social Security benefits. So we'll see how that goes there.
Right.
Or there. Another area that is kind of, again, there's some things that are good, some things that are bad. Many people have casualty losses. They have a flood, their basement gets flooded, sewer backs up, windstorm comes through and wipes out homes and things of that nature.
Yeah.
And previously, you could declare casualty losses as a deduction on your tax return if you documented and all that, proved everything. Well, one thing here is that you're no longer able to deduct casualty losses from property damage and things unless that event, that weather event or that natural disaster has been declared a disaster area by the federal government.
Really?
Yeah. So you have to have a presidential federal government declaration that this is a federal disaster.
Right.
And then you can deduct your casualty losses. We have a lot of small regional events.
Right.
A tornado comes through here, rivers back, things like that. So you've got to be real careful in interpreting and see how it works out going forward. But that was kind of one of the things that didn't kind of took back some deductions.
Sure,
from that.
yeah. If we have a random tornado come through and one house in the community has a tree go through their roof, that
just
wouldn't
straight
work,
line
right?
wind and things like that, yeah. Has to be declared a natural federal disaster by the government. Yeah.
Interesting.
Which is kind of interesting.
Yeah.
I've had a lot of people ask me, now Steve, I donate to my church, to my charity, and nonprofits and things like that. Will I still be able to deduct those charitable deductions? And yes, the answer is yes. You have to itemize though, which brings us back to the first point we made. With the raised standard deduction, many individuals will not have to itemize to reduce their taxable income. With the standard deduction going up so much, some people itemize this year may not need to itemize next year.
Gotcha.
And to get credit for the standard, the deduction for charitable giving, you have to itemize. So we're going to kind of see some charities are a little nervous. We all know that a lot of people give money at the end of a year purely to reduce their taxable income.
Interesting.
Not necessarily out of the good of their heart, but to
Right.
get a tax deduction. And I'm encouraging everyone to continue to give. Our country thrives on charitable contributions.
Right.
The good they do, the good that's done through a charity is much better good done, that's bad English, through government agencies.
Right.
Let's put it that way.
Philanthropy is, I think, rampant and strong in our community.
And it's alive and well.
Yes.
On that.
Yes.
Another thing that was kind of a negative, I mentioned that next year may be a good time to hire a professional tax return.
And we have a lot of great ones in our community.
absolutely.
We are blessed there, definitely.
However, as part of this act, fees that you pay to tax preparers, legal fees, and fees to financial advisors that you pay, those will no longer be deductible from your
Really?
taxes. So at the time when you really need tax advice, legal advice, and financial advice, what you pay those individuals going forward will not be deductible. So anyway,
Yeah.
but dollar for dollar, it's pretty well worth your getting
no
the advice there on
no
that
doubt.
there.
They will find the information. You don't know what you don't know, so
Right.
it's always good to talk to a professional.
Talking about tax, this is 2017.
Mm-hmm.
Now, normally we know that we have to, our tax returns are due by April 15th.
Mm-hmm.
Well, this year it's April 17th
Okay.
for a couple of
They
reasons.
need to quit messing with that. I've got
Well-
April 15th in stone in my mind.
April 15th falls on a Sunday, so we know that won't work.
All right.
April 16th, only in the District of Columbia, Washington, D.C.,
Mm-hmm.
it's a national holiday, or it's a holiday called Emancipation Day. So April 16th is Emancipation Day, so no, the government's not open that day.
Wow.
And so it's Tuesday the 17th this year.
Well, alrighty
So
then.
keep that in mind as we go through there. It's a legal holiday only in Washington, D.C.
Sure, I'm
but,
sure many folks appreciate those extra couple of days.
Right. And then we did get a notice from the IRS that if you file your tax return by the end of January and going forward, and you're due a refund, that they anticipate being able to process those refunds within about 21 days, about
Really?
3 weeks. Yeah.
Across the board?
Yeah.
Wow.
I mean,
Does it seem like-
at least 3 weeks after you file your return.
Wonderful. It seemed like it was an issue last year. Did I?
Yeah, they ran into
Yeah.
some delays and things of that
Right.
nature. And on the subject of refunds, last year, 75% of taxpayers, 3 out of 4,
Mm-hmm.
got an average refund of $2,800.
Wow.
So it might be nice to get that big bump check, $2,800.
Sure.
But however, you have loaned the government $2,800 for no interest
Yeah.
throughout the year. So keep that in mind as you go through that.
Sure.
there.
Yeah.
So-
Note to self.
No, on there. One other thing that they expanded a little bit, 529 educational plans, where you as a parent or grandparent can put money away for a child or grandchild's education. They've now have spent that to about $10,000. They made it available for K through 12 expenses for children. Even now expanded that if you homeschool your children, that you can use that money from the 529 plan to pay for expenses for homeschooling.
That's awesome, 'cause that's more
materials.
common,
Yeah,
more
very
common,
common.
sure.
And so it increased the benefits of 529 educational
great.
plans, which was kind of good too there.
Yes.
So we're excited about that.
Certainly.
On there. There was a few other data points. Oh yeah, here you go. For individuals who have large estates, own businesses and things of that nature, we always talk about, well, this death tax. When I die, I'm going to owe the federal government so much money and stuff. Well, for 2017, it was $5,450,000, meaning you could die and not pay any federal, state tax, death tax under that amount.
Right.
If it's over that amount, you're subject to an estate tax. Well, under this law, they've doubled that to almost $11 million.
Wow.
Meaning you can die, pass over $11 million to your heirs without having to file or pay any kind of federal state tax.
Well, that's handy.
Yeah. Well, that's real handy.
Yeah.
But the good news is we have a lot of individuals that gift their children money every year. And it was $10,000 a year that you gift the children, grandchildren, whatever. Went to 11, 12. It was $14,000 last year, a couple of years. This year, it's been adjusted for inflation. It's $15,000.
Right.
So individuals who gift to children and grandchildren, they can give $1,000 more, $15,000.
Awesome. You need
Yeah.
to send my parents a note about
Okay,
that.
I'll do that on that there. But anyway, that's kind of
Yeah.
a good benefit there. So anyway,
Well, it looks like we're just about out of time, actually.
we are.
Yes,
can
it's
I
crazy.
hit one quick thing?
Yes, throw it
All
in there.
Corporate tax rates. That's all this stuff.
Yeah.
All right. Corporate tax rate was 35%, meaning companies that made money overseas, and if they brought it back money to the United States, they're going to be taxed 35 cents on the dollar.
Wow.
This law changed it to 21 cents. However, the reason you're reading all these headlines about all these companies bringing money back now
Yes.
is that during 2018, there's a one-time rate for this year only of 15.5%. So they're bringing the money over, they're paying a tax. All these companies, from Apple to Disney, Citibank, I mean, all these companies
It's
are
all
bringing
over
this
the
money
papers.
over
Yeah.
every day, and they are giving their employees bonuses with
Yes.
it, putting money into the 401ks.
It's awesome.
And the tax benefits of that corporate tax rate being reduced and the money flowing in is really going to have a widespread effect on everybody. That's why I saved that for the end. I got all this.
There you go.
We're good.
There you go. Awesome. Thank you for sharing that. You cannot look on Google News or in the Wall Street Journal, any of those papers I know you read every day, without seeing some big company doing that, paying that money forward. And now I know why. I sort of skim some of it's over my head, but it's interesting to know why they're doing that. It's amazing. Steve, thank you so much for your time. Appreciate you. I know you're all over the country, and we have to work hard to get you in that seat, so I'm glad we were able to do that. Thank you for the information. If anybody has any questions, we have a screen here at the end with contact information for the Wright Legacy Group, and Julie or Steve will be happy to answer any questions you have. You all be safe, and we'll see you next time.
I consider it an honor to be able to work with my father. It's always a unique experience, not only having been raised by him, but now working alongside of him. I get to see how consistent he is. The principles that he raised me with, I get to see him work out every day and live out in the way that he works with clients, as well as the way that he leads the business.
3 decades ago, I went on my own, hung my own shingle. When you do that, you're taking a lot of risk. That's what entrepreneurs do. But I came to a point in life that I got tired of trying to live by other people's rules. There's a higher standard of the rules that I want to live by and raise my family by.
I saw the way that he was able to just build relationships with those that he was working with. You could just tell that what he was doing made a difference. And that's something that I wanted to be a part of.
The word legacy is a word that's been around a long time. Legato, I think, is where it actually, the root of the word there. The Bible says that a wise man leaves a legacy, an inheritance to his children's children. So in our planning, we are trying to make sure that people are not only living and take care of their needs of their family today, but are creating a long-lasting effect so their children and their grandchildren can have a better life and a better future. The Wright Legacy Group is a combination of advisors that can provide individualized, tailored plans to families, teenagers, the millennials, the Gen Xers, Gen Yers, and the seniors that we love so much.
A legacy is how you're remembered. A legacy is who people see you are and what your values are. It's not just monetary, it's about who you are and what defines you.